Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey. Welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. Today, Josh, we are going to be talking about company stock.
Company stock, right. And by the way, if your company was a farm, you would own beef stock, chicken stock, vegetable stock.
Do you know where you get all that stock?
From the farm.
No, the stock market.
Oh, the stock market.
Yes. Considering this isn't really a cooking show, although sometimes it creeps in there a little bit because we're foodies. We love to eat mostly donuts. Oh, I just ate a donut this morning.
Was it good?
Powdered sugar cake donut. Delicious. Kroger, weirdly enough, in their bakery section, they have these little prepackaged 12 donuts, 3 kinds. There's powdered sugar, powdered cinnamon sugar,
those are good.
and plain.
Yeah.
And
boring.
The cinnamon and the plain I like, but I prefer the cinnamon, but I can't have all the cinnamon,
Why not?
share. Actually, Jenna likes the powdered sugar ones, and I don't.
Right.
So we kind of
that's why it works.
So I usually get one cinnamon sugar, and one plain one, and then I'm all set. And they're moist,
cinnamon are good,
delicious.
Whatever that.
I know,
because that powder, it's
so good.
Now
So
I'm
anyway,
hungry.
that was totally not what we're planning on talking about today. But I love donuts, and I had one today, and I was jamming on it pretty hard. So yes, we are going to be talking about not cooking stock, but instead, if it is a good idea to own stock in the company that you work for.
Okay, so that's what we mean by company.
But Josh, first and foremost, how can people help us to continue to grow this podcast, help lots of people, and put out new episodes each week that are answering the questions that people have about finance today?
Are we at the end of the podcast already?
You would think so, but guess what?
Switching it
We're
up.
not.
Switching it up. Yeah. If you're enjoying this podcast, obviously subscribing gets you a new release every Thursday. Leaving reviews, like we've said in the past, help us rank. And emailing us, and this is the most important one. We love hearing from you guys and girls out there. Email us questions, thoughts, topics, all that stuff. We love to see what you guys are thinking about and what you would like to know more about. And then also, we're talking about company stock. If you know someone that owns a lot of company stock or has been talking about that option with their employer, make sure you send this episode to them.
All right, well, let's get down to the nitty-gritty in ways that you can own company stock. So the first one is an employee stock ownership plan. And that, of course, has a great acronym.
ESOP.
Because it's in the finance industry and everything that we do has fun acronyms. Some fun facts about ESOPs. And I found an article that was from the NCEO, which is actually like an organization about company ownership, employee ownership.
There you go.
I'll link that in the show notes below. But I got some interesting statistics now. They're a little dated, but they should give us a directional idea of what we're talking about here. So over 6,000 companies offer ESOPs in the U.S., and as of 2018, this represented over $1.4 trillion and covers over 14 million participants. Over 600 of those companies, of that 6,000, so about 10%, are publicly traded. So this actually means you can own company stock in a privately traded or privately owned company as well. But Josh, dig in a little bit about an ESOP in general.
Yeah, so ESOP or employee stock ownership plan is just that, stock ownership. And so they are giving stock to employees either as a bonus or some sort of incentive, part of their pay structure. And like you mentioned, 90% of these are actually not publicly traded, meaning they're not. You can't go out and buy them out on the market. So what is this ownership then? If I can't sell this stock, what is it? Well, it is ownership in the company, so you get, in a sense, to participate when it does well. And so whether it's publicly traded or not, owning stock means you own a portion of the company. And so it's there as a motivation. It's usually alongside a 401k or some sort of other retirement plan as an additional piece of that. And so that's what it's there for. But it's a way that they can give you and motivate you through ownership in the company you work for.
So not to be outdone,
Yes.
there's another acronym, employee stock purchase plans. So this is not necessarily the giving of the stock. This could be the purchasing of the stock through your employer, and that is an ESPP, employee stock purchase plans.
ESOP, ESPP.
Right, and this is kind of similar, but in general, one of the options that I've heard of in a lot of instances here is that employees with these options on their table can often purchase company stock at a discount.
Yeah. So let's say you get a 15% discount for what is currently traded at.
Yep, and sometimes you have to hold them for X number of time before you could sell them, but no matter what, you're gonna get a discount from the price when you bought it, and then if the price goes up or even stays the same, it could go down, but you could be ahead. So that's another way to incentivize your employees to hold company stock. I know that, speaking of local Northwest Ohio things, Owens Corning up in Toledo used to have a plan like this, so a lot of employees could get company stock at a discount, and a lot of them did. Another way you can own company stock is through your 401k or retirement plan. Josh, talk about that a little bit.
Yeah, so if you have a 401k or 403b or any kind of retirement plan at work, you have usually a list of things you can own in that plan. So they usually give you a menu and say, here's your choices. Sometimes the company stock, especially, and probably only if it's publicly traded, is it included in this. If it's not publicly traded, it would be on the ESOP side of things. But if it's a publicly traded company, you may not have an ESOP option, but you may be able to buy it in there.
Correct.
And so what you're able to do is say, okay, every paycheck X amount comes out. I want a portion of that to go into company stock. So you elect that to be one of your holdings.
So, first of all, two things.
Yes.
Every time I see the word 401k, I laugh in my head because I think of Phoebe Buffay from Friends saying 401k.
401k.
And we just watched the Friends reunion.
Was it good?
On HBO Max, and it was heartwarming.
Yes.
It was not necessarily, if you're a Friends fan, you'll love it. If you just want to watch it for entertainment and you didn't really get into the show, you'll be like, this is kind of dumb.
Yep.
Because there was a lot of crying and things like that.
Emotions.
So anyway, we watched that. That was funny. Number two, the company that you have this option through likely, or should, have some sort of limit, and we'll talk more about this later, but it is likely that you will have some sort of cap on how much of a percent of your retirement can be in your company stock, because we'll talk about some examples where that can go bad, but that seems to be a protection for employers about their employees holding too much company stock.
And some companies have a requirement for certain executives to hold a certain percentage.
It goes the other way.
Company stock as well.
Yeah, and we're going to get into the benefits of those things later, but keep that in mind that there may be some sort of limit there, and I know that a lot of these changes aren't actually that old, and I think there actually might be laws around this, but there was at one point really not a lot of limits on what you could hold. So I used to work at Cooper Tire. There used to be pretty much free for all on holding company stock in your 401k, and a lot of employees got burnt when the stock price follows the tire industry pretty closely, and you have a bad couple quarters, and your retirement could look pretty bad.
Would you say the tire industry is circular?
Oh, stop.
I'm just wondering.
Josh,
I don't know.
It's not where we're going today. You and your jokes. Another way you can hold company stock, Josh, in an outside investment account.
Yeah. So, again, if it's a publicly traded company, anybody can buy the stock. And as long as you don't have any restrictions or rules for your employment that you're limited to what you can do, then, yeah, you could just buy it on your own and hold it in an outside account, a taxable account, Roth IRA, doesn't matter, traditional IRA, who cares? You could own it.
Yes.
But again, if you're in certain industries, you may have rules or restrictions on what you can and can't do based on what knowledge you have and what part of the company you work for.
Yes.
But that is an option for anybody in most cases. Just to say, hey, you know what? I work for Disney. I'm just going to buy Disney in my taxable account here.
Right.
Okay, that's fine.
And you have more flexibility when that is the instance. However, yeah, like you mentioned, depending on where you work or what industry or what part of the company you work at, you might be privy to insider information, and thus you might have blackout periods, and you could be, if you're not careful, you could violate SEC rules, and people get very unhappy about that sort of thing. Mostly the SEC, yes. And finally, I guess it's not finally, but the last bucket we're going to talk about today is you can really attain company stock through grants and stock options. So that's just kind of self-explanatory. You could be given stock through a stock grant from your company as an incentive of some sort. That can be a variety of different things. You can also be given options to buy company stock at X price. That's usually how it works. These are usually call options, the right to buy. I always remember like call and put verse, because call is C and buy is B, and that's at the beginning of the alphabet, and put is P and sell is S, and those are at the end of the alphabet. So I just think right to buy a stock.
There you go.
Call option. So you're usually
given,
if you're given an option, it's usually a call option. It's to buy
they
stock.
don't need to sell things.
And you're buying, the option is to buy stock typically at a very low price.
Yep.
And I'm thinking of specifically in my mind, the example is Elon Musk. He obviously actually owns a lot of Tesla stock, but a lot of his compensation as the Tesla stock hits X number of prices, he gets huge
the goals,
stock.
yep.
He gets options.
Yes.
He doesn't necessarily get shares. He gets options, and then his profit comes from the spread between the option price, which is usually really low,
Yep.
and the current price, which is usually really high, which is how he's so rich.
Yep.
So
And so it's kind of like, all right, I'm working for this company. If I hit these goals, I'm going to get some stock options. In the stock option, it'll say, hey, you have the right to buy X amount of shares, and you can buy it for $10 a share. Now, if it's trading for $8 a share, I'm not going to exercise those options.
Correct.
I could go on the regular market and buy it for $2 less.
Yep.
If it's trading for $20 a share, man, I'm going to exercise those
Heck yeah,
options.
you are.
I'm going to buy it for 10, and it just doubled in price because it's currently worth 20. So that's how a stock option works, like you said. It just, you have a set amount that you could buy. Usually they limit you, and then they also tell you what the price is that you're paying for it. Then you decide. You don't have to. It's an option. You don't have to, but you can if you want. And they usually give you a time period. It
Yes.
expires after a certain time.
Exactly.
That's what they are. Pretty easy.
So let's kind of look at this, as we often do, in two different ways. So let's talk about the benefits to the company, and then we'll talk about the benefits to the employee after that. So speaking of the company,
Yep.
it is a good thing for the company. They have some benefits that they can do by issuing stock or offering stock options to their employees. Number one, it's cheaper than cash. You're just really using your equity, your company
Yes.
equity, to fund incentives, which is a good thing. And there's tax benefits wrapped up in all of that, which is actually the reason that it's most beneficial.
Yeah. And you'll see, too, a lot of startups do this, right? Because they don't have a lot of cash flow. In fact, they probably have negative cash flow. They're burning money.
Right.
So in order to give a motivation and incentive to the employees, they may say, hey, we'll give you a little bit of ownership in this company. You know it's going to do well. We know it's going to do well. Just not there yet.
Correct.
Jump on board. And so, yeah, you see a lot startup companies especially do that early on. You hear those stories, right, about the janitor or I think there was a story about a masseuse that came in and, was given stock as incentive pay, and then down the road, oh, look, we went publicly now, publicly traded.
Millionaire.
Stock price jumped, and now, millions of dollars. So, yeah, that's a cheap, like you said, cheap incentive and a cheap way of motivating and giving compensation.
Absolutely. It's another benefit to the company is you can get key buy-in from key employees. So think about a company's leadership team. If you're either giving them stock as part of their compensation or as bonuses or whatever, you're motivating them to be a part of the vision and the mission of the company to continue to grow and do well, and then they will do well as well if that continues. Another reason that's very in the front of investor minds now is that it aligns employees with employer interest. So, to the company, they have a goal to do whatever the company's goals are, and if the employees own a bunch of the company, they're aligned to do the same thing.
Yep.
And the shareholders are all aligned the same to point the same direction, and they're all on a common goal. And a point that we should talk about is that you'd think that, companies are issuing new shares or offering new shares for their employees or whatever. You'd think that the shares would go up, right? Well, they do. But companies this is really one of the reasons that stock buybacks became a thing in the 80s, is to offset the new shares being issued, just so you could have at least a flat share count for your EPS calculations. However, companies have actually typically are buying back a lot more than they're issuing in new shares, which is helping their earnings.
And one other thing for a benefit of the company, when you talk about the compensation, some employees, especially the highly compensated, saying you have a 401k, well, that's great, but if maxing it out, I could put $19,500 in, that may not be a very big percent of my compensation, and so I want more.
Right.
What other ways can I save for my retirement?
Right.
And so adding these things is another layer of helping that employee to save for their retirement by saying, hey, not only can you max out your 401k, but we're going to give you these options, or you have the ability to purchase whatever the plan is. You give them another way, because that's, they're looked at as another plan. It doesn't count as part of the 401k.
And if you look at the percentage breakdown on like key executives, CEO, CFO, these kind of big wigs at publicly traded companies, their compensation is usually broken down so that the vast majority of their compensation is within stock options and stuff like that. It's not necessarily cash payments for their salary. Sure, they might make a few $1 million in cash. That's good living,
right? Yeah, that's all right.
But they can make many millions of dollars in stock and stock options.
Yes. And if it does well, like you said, motivation, then that is even more valuable of an incentive than just cash.
Absolutely. So let's flip the page, talk about benefits to the employee. And I think we kind of hit on some of these things, but it's additional incentive to push the company to financial success. So your interest, as you're a larger shareholder now of the company, your incentive is to make the company do well, and which is going to make other shareholders do well, and everyone wins.
Yep.
So you're a part of the company there. Obviously, wealth creation is a big portion of that as well in terms of your compensation. But you also get a sense of loyalty to your employer, and companies will benefit from you being incentivized to stay. Because a lot of times, like we said, there's some restrictions on what you can do with those. So that's something to keep in mind as well. So yeah, I think that there's benefits to both sides of the picture there.
Yep. Both. It's not a one-sided where look at the company really makes out when they do this. No,
right.
Both people get a benefit. Like you mentioned, the sense of loyalty comes with a piece of that usually being what we call a vesting schedule.
Yes.
Meaning not all of what they give you is available right away.
Yeah.
And depending, and again, there's rules around it, but you may see a 3, 5, 7 year, just depends. But the vesting means how much is yours and how long do you wait for it to show up. So if, let's say you have a 5-year vesting schedule, okay? So each year, 20% of what they gave you becomes yours.
Right.
So over the 5 years, you get 100% of it in the 5th year. So that motivates an employee to say, hey, you know what? I should stick around for 5 years to get all this stuff they just gave me.
Yes.
Right. And so, and then if you add it along the way, you kind of layer these vesting schedules. So you're always kind of encouraging the employee, hey, keep sticking around. You're going to get more stuff. So,
It's similar to a 401k plan in general, where a lot of companies have vesting periods where you may be completely vested after 2 years, but you can't. But if you left before 2 years, you would not be able to take all the money that the company contributed.
Yep.
Whatever.
Yeah, there's all different rules there. So that is there. But overall, employee stock option plans or any kind of company stock incentives are there not only to help the employees, but it also the company itself gets some tax breaks as well as motivation to keep those employees. Low turnover is great.
Absolutely. Josh, I have a dad joke of the week for you.
All right, I'm ready.
What do you call a bear with no teeth?
A bear with no teeth. I don't know. What is a bear with no teeth?
A gummy bear.
A gummy bear. I like it.
Gummy bear. That's a really good one.
I like it.
That was from Reddit.
I love gummy
of course.
bears.
That's where they all come from.
That's the best place to get jokes.
Okay, and gummy bears, speaking of gummy bears, Haribo, the German gummy bears,
Yeah.
those are the best.
Yeah,
For sure the best gummy bears.
those are good.
Oh, man.
Good gummy
I would eat a couple right now. I can't eat too many. It's a lot of sugar.
I like gummy snacks in general.
They're
Yep.
pretty good. Fruit snacks, I'm not above a fruit snack. I don't want to
All the
know a
time.
person
I had
who,
one the other day.
I don't want to know a person who doesn't like Gushers.
Oh man,
They're not my friend. All
Gushers
right.
though are dangerous. If you don't know they're a gusher, and you take a bite, you could choke.
Give it to your grandma.
Yeah.
You know, she'll be like putting it in her mouth and it'll pop. And she'll be like, oh, my land. It'd be so
Surprise.
funny. Okay, so yes, let's kind of get a little bit more practical and
Yes.
talk about some historical examples even. So why should or shouldn't you own company stock, Josh?
All right. So why should you? Well, I'm participating. I'm getting value for me working there, right? So I should own company stock if, one, I'm able to get it at would either be a discount or free. You know, if it's a employee stock option plan, they're giving it to you. If it's some sort of grant or stock option, make sure it's of value. So I don't.
Right.
Again, I don't want to buy a $10 option when it's trading for $8.
Yeah.
I just go out
Be
and buy
smart.
it on my own. But why I should own it is because I have a buy into this company. It makes me more motivated to see it do well, and I get to participate more in the success. Why should I not?
Yeah, there is a downside.
There is a downside.
So think
Now,
about this.
I'm not saying that you shouldn't own any, but the big piece, and this is what we're going to talk about when you look at historical examples, do not own too much
Yes.
in company stock. And this is where Austin and I, there's no hard number to this thing, but the idea is you don't want to be over concentrated in any one of your investments. And this is true not just for company stock, but in general. You want to be diversified. We've talked about that in the past. Diversification is important. If you have 50% of your net worth tied up in your company, that may be a little bit too much.
And you might actually have indirectly more than that, because if you think about it, your company is already probably providing all of your insurance, all of your actual paycheck, all of these other benefits to you, as you know, your livelihood. If you want to add on an extreme amount of additional leverage to that company's success through the stock ownership. Some we say is okay, but you do too much. You have a lot of your eggs in one basket. And
Be very
not all
careful.
companies are going to be around forever.
You can have a little bit of bias because you're working there like, oh, this is the best company ever, and maybe the stock market doesn't agree. And you may actually be doing well. The company's doing great, but their stock price is not.
That's correct.
That could be a problem. So, yes, just be very careful why you should not own too much in company stock.
So let's look at some examples, Josh. So there are some great examples of company stock ownership plans working out well. And the things that come to mind are big tech, right?
Yeah.
Google, Apple, Facebook, they have excellent company stock plans, excellent incentives for employees around that. And those, thus far, have done exceptionally well and have really made some fabulously wealthy, Silicon Valley people.
Yes.
So those are some great examples. So let's just put that off to the side. Great examples.
And like you said, 90% of these plans are
private
companies. So again, you're not seeing these stock market
Yeah,
moves.
you're right.
If the company continues to just grow and do well, that ownership is going to grow. You're just not going to see that value daily because it's not traded.
Right.
And so those are, great. These are all publicly traded. It's easy to see that success in the stock price, but it's those small, couple, maybe 50 employees type of thing where they're saying, all right, you know what, we want everybody to have an ownership. Here's some stock. When they call it stock, it's not traded on the stock, but it's ownership in the company. You guys all have that. And then when you leave, okay, here's the new value of our company. It's grown, and now each of your stock is worth more, and you get an incentive when you leave.
Right.
So you're right. Great examples. A lot of times they're the unknowns. Those little small companies you just don't see.
Yeah.
Are great plans.
So other side of the coin,
Yes.
there are some bad examples.
Bad
And here I'm going to talk about one here.
Okay.
So we all remember a company called Enron, about 2000 things. It was the hottest company in the world.
Doing well. It was big.
I'm going to know it was doing well.
Doing well.
Air quotes on a podcast.
Okay.
The numbers that were fudged made it look like it was doing great, right?
Yes.
So the story goes 2000. So I was 9.
Jeez. You're so young.
Enron, the leadership at Enron was urging its employees to buy company stock right around August of 2000. And shortly thereafter, employees were in a lockout period, as we kind of talked about. They couldn't trade their shares, so they just
the lockout period is just saying, hey, because either you bought
You have
company
insider
stock, or there's
information, who
insider
knows?
information, or the company's getting ready to do something.
Yep.
There's a freeze.
and the freeze really was around earnings.
Yes.
And what was coming with earnings, and what came with earnings, and so earnings were released. They were terrible. There was $1 billion write down, all these things. Worst quarter in history. Oh wait, we're also going to file for bankruptcy because we
We're out of
were
money.
pretty much out of money and we were running a fraud the whole time. So company shares $90 in August. So September earnings came out. All that happens within a month. Stock down to $25.
Ouch.
A share. That's less than a third of the original stock price, okay? Then another month later, $15 a share. Another month later, $4 a share. And within 4 months of that original push from the leadership, shares were delisted from all major stock exchanges because they went bankrupt. And they were only traded over the counter, which is not on a major stock exchange, much less liquid, much more volatile, yada, yada, yada.
There is no actual counter that you're trading over.
Yeah, this isn't
I
a real
looked.
place.
I couldn't find it.
Yeah.
But it just means outside of the normal exchanges.
Yes.
Is you're finding another person to trade with.
Yeah. So within 4 months, stock was trading at 51.5 cents per share from $90.
Wow.
So many employees got utterly toasted
Yes.
by being encouraged by people that they believed in to lead them. And a lot of them probably thought, hey, things have been going so well. Look at our numbers. I'm going to put a lot of money into company stock here because it's just gone crazy.
Yep.
And then they weren't able to retire.
Yes.
Probably.
Or their retirement was completely
Yeah,
changed
exactly.
and destroyed.
Like, if you put all your eggs in that basket,
Yep.
you were severely pushed back on your plans no matter what stage of life you were.
Yep.
So,
Another more
bad
recent example is GE.
Yeah.
And there was a high ownership of company stock there as well. GE had some really bad issues in the last decade or so. Their stock price dropped significantly. I think they stopped paying their dividend for a little while. There's a lot of issues. Now, since recovered.
Yeah.
But again, it's a timing thing. If I'm getting ready to retire, I may not have another 10 years to wait for that
Right.
stock price to recover. And if I have a lot of my retirement tied up into there, so that's, again, the problem is it's not everywhere where it's going to be bankruptcy, end of the company, but there may be a time period where your company underperforms and the stock price follows suit. And if you
Right.
have too much of your net worth tied up into that, that's where you could struggle.
Yeah. And I'm thinking it specifically if you're working in industries that are extremely cyclical.
Yes.
So energy, oil
Tires are
industries,
circular.
tire industries, that's the circular one. Suppliers for these industries, upstream, downstream, whatever, materials, industrials, things that follow economic cycles and stuff like that, commodity cycles, those can be tough to time with your retirement.
Yep.
So suppose you've got a lot of your eggs in one of these baskets and you're working at an oil company and oil prices tank and you're about to retire. Well, guess what? The company stock's going to tank too.
Yep.
And that's not necessarily great for timing. So that's why we're preaching diversification is key. And on that note, Josh, how much company stock should you own? It depends.
Yes, depends. Like I was like, but not more than you can stomach from one individual stock holding, and
Right.
that's really the key. And you need to talk to your financial advisor about what that number is.
Absolutely.
Again, depending on where you're at, maybe you have a big pension, so maybe you can take a little more risk because you're not going to need as much to draw out of, and you can let it recover. Who knows where you're at? But talk to your financial advisor and help them come up with how much should I own in company stock. What are your thoughts? Anything
Yeah,
different?
no, I totally agree. I think moderation is a thing you've preached a lot. I think that this is an excellent opportunity for some moderation. You can, treat it like a stock holding in your portfolio, not like the base of your portfolio.
Yes. Mm-hmm.
And that's good. And we want, it's cool to see that you own the stock where you work and you're following its success and its news and all of that. But let's keep the long-term picture of a well-diversified plan in mind here.
And don't think you're going to offend your company by selling company stock. They gave it to you as an incentive for you to use to better yourself and your family. So whatever that means,
Right.
whether it's selling or holding, you make that decision. It's not like you're showing disloyalty by
Right.
diversifying.
And another thing that we should probably point out is depending on how long you work there and how much of this company stock you accumulate, if you go to retire, you could run into some liquidation issues that involve big tax bills and things like that because you could have had a really low cost basis. You've been working there for a long time and the stock could have gone up a lot. Well, if you would have been a little bit more diversified over time, you could have avoided some of these big bills. This is things to consider when you're looking at your overall picture.
And on that note, there is a thing called net unrealized appreciation.
NUA.
So NUA is a way of getting your employee company stock, out of an ESOP plan and getting it taxed at a more favorable rate. It's really detailed and nuanced, but high level, all of your
NUA is nuanced?
yeah.
Oh, man.
All of your cost basis, so whatever your cost is. So let's say you're given these shares in the ESOP.
Cost basis is going to be zero.
They'll assign a cost basis to what it's worth in
fair
your
market value.
compensation,
Gotcha.
and it's usually actually even lower than that. So you may have a stock trading for, again, 90% of these are not publicly traded. They still have to assign a value, and so they have to have this whole thing, and they get somebody come in and a value, and then you divide it, and blah blah blah. But they may say, you know what, it's $1. Your cost basis is $1. Now it's trading for $15, and so you have a capital gains of $14. And so that $1, if you use the net unrealized appreciation, you pull it all out of the employee stock option plan, it goes into a taxable account, but you only pay for the cost basis, you pay income tax. But that's the lower amount. You have $1 per share of income tax. The rest is capital gains and long-term capital gains.
Lower rate.
Which is either 0, 15, or 20 at the current tax brackets. So you actually could save some money, but that's a big tax bill. And that's only due when you sell. And so if you hold on to some of that stock, you only realize it at the sale, so you could spread it out over a couple of years. So there are ways around it, but there is going to be a tax bill at some point.
This could also be an option for doing some gifting.
Yes. Yeah, appreciated stock is a great thing.
As we've talked about a couple times before. So we're not gonna hammer on those things right now, but just things to keep in the back of your mind because taxes are real.
Yes.
Got to pay the piper at some point. Josh, any closing thoughts?
Nope. Just remember that that's a great incentive if your company offers it. Just be careful you don't get too concentrated into one stock, even if you really like the company you work for.
All right. Well, until next Thursday, have a great week.
All right. Talk to you later.
Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.